It is September 16, 2016, and I'd like to welcome you to the first EXIT Readiness podcast. My name is Pat Ennis, the founder of ENNIS Legacy Partners. The mission of this podcast and future podcasts, as well as our firm, is to help business owners who want to build transferable value in their business, stay in control of their exit, and leave a legacy. We provide consulting service, coaching services for business owners. We also want to be a source of information and education through our seminars, our workshops, blog, newsletter, and now these podcasts. The plan is to run from 15 to 30 minutes interviewing a subject matter expert on an important topic regarding exit. Today's guest and subject matter expert is CPA Walter Deyhle, who is a partner at Gelman Rosenberg Freedman, CPAs in Bethesda, Maryland. Walter's also a certified valuation specialist, and that's the topic today, the importance of an accurate business valuation in planning a successful exit. John Brown, in his book, Exit Planning, The Definitive Guide, talks about the misperception spell and how one of the common misperceptions of business owners is what their business is actually worth. Walter, thanks for joining us today, and that's my question to you. Do you find that to be an accurate assessment, that there's a common misperception with business owners about the value of their business?
Yes, I think that is definitely a common misperception amongst business owners. And I think it goes back to a phrase you had in your opening comments, which is transferable value. And I know you emphasize this a lot with your clients, and I think that's really a critical point, because a business owner looks at his business as the amount of money that he is generating while he runs it. But let's take an example where it's a small business. The owner is really the marketing department. All the contacts are his. All the customers are based on his relationships. So he sees the money coming in from those clients, and he determines his value based on that. But someone buying that business is going to be very concerned that with the current business owner gone, some of those relationships may leave. So they don't see that cash flow stream nearly as certain as the existing business owner does. That adds risk to the equation, which drives down the value of the company. Another easy example or simple example is it's a great company, but they have one really big customer. Well, from an outsider buying that company, that makes the company very risky, which again reduces the value, and owners oftentimes don't see that.
Walter, I know there's more than one way to evaluate a business. I wonder if you could take a few minutes and describe each one of the methods and when one method might be used over another.
The methods really fall into kind of three broad categories. There's the market approach, the income approach, and an asset-based approach. So a market approach, one way of thinking of that is sort of like when you sell your house. When you sell your house, the real estate agent comes out, he looks to see what other similar houses have sold for and prices your house accordingly. It's the same way in valuing a business. Of course, the difficulty is it's hard to find a business exactly like yours. So oftentimes what happens is that there are databases that do report sales of companies and give you the details of the transactions. It can still be a little difficult to make sure you're comparing apples to apples. But that is one approach. It's not one that we use that often with smaller businesses because of the difficulty of finding a real good comp. The income approach is really the preferred approach. Within the income approach, there's really two major methods. One is the discounted cash flow method. That's where you forecast out the earnings of a company, and then that's your cash flow stream, and you discount that back using a discount rate. In a situation where a company is well established, their earnings are pretty consistent year to year, you can use something called the capitalization of earnings method. That's where you take the average of historical earnings and capitalize it to get you the value that way. The thing to keep in mind in the income approach is that you're looking at the company like you would any other investment. Your return is going to be the cash return that you can generate, and then the risk is going to be, well, how risky is that cash flow stream? So you need to determine what the cash flow stream is, and you need to determine how risky it is. So normally You use earnings before interest, taxes, depreciation, and amortization. That's EBITDA. And you apply a multiple to that. And that gives you your value. The higher the multiple, the less risky the cash flow. And then the asset approach, you don't see that a lot in this area, but it would be a common approach in an industrial company where it may have a lot of assets that are worth something. Around here, a lot of businesses are really more intellectual capital. There's not as large asset base. So you don't really see that very often.
So why is a business valuation essential when planning to sell or transition a business?
Well, I think the answer to that question, again, it's something I've seen you emphasize at your seminars, is what you refer to as the gap analysis. So the idea is, a business owner needs a certain amount of money in order to ensure a successful retirement. So he needs to know what he has to figure out if there's a gap that needs to be filled there. So in the case of most business owners, upwards of 90% of their wealth is in their business. So it's critical that they really know how much that business is worth. If they're doing planning based on, my friend at the country club sold their business for 5 times revenue, that is not a good way to approach your retirement planning. So I think the key thing to remember there is, I always look at the business valuation has to be done in conjunction with the other financial planning. That's really the key, is that you're really looking at what does the owner need for a secure retirement, and then what piece of that is the value of the business going to fill. Very
good. So, you hear terms like estimate of value, certified valuation. What's the difference between an estimate of value, certified valuation, and any other terminology that's used to describe different forms of valuation? And then when is a certified valuation needed?
Okay. So there are different levels of valuations that can be done. And, like anything else, having a CPA background, people throw out lots of terms for different types of financial statements. Well, it's the same way in valuations. There are different levels of work that is done and put into a report. Generally, there's 2 types. There's what's known as a calculation report, and then there's a full comprehensive business valuation. One big difference is the cost. A full-blown business valuation can range anywhere from $12,000 to $30,000. A calculation report is probably going to be half that or maybe even less. So in the situation where an owner is thinking about starting exit planning, he really isn't going to need a certified valuation. He just needs to get a good, solid idea of what his business is worth, and a calculation report will oftentimes do that. So with the comprehensive business valuation, there's a lot of things that are required. So, for instance, you have to do an economic study, and those are great, but they take time. They fill up pages in the report, but at the end of the day, it's not all that critical to the report. But it's something that is required for a comprehensive report. Also, for the comprehensive report, you have to look at the market approach, the income approach, and the asset approach. Even if you're not going to use them, you have to look at them and then explain why you didn't use them. In a situation where it's obvious you're going to use the income approach, it's kind of a waste of time and money to have to look at the other ones. So a calculation report, I think, works very well in the very early stages. Calculation report, the business owner and the valuation specialist agree the procedures that are going to be applied. So if we know the appropriate approach is an income approach, then we would agree we're going to do, for instance, a discounted cash flow model. And we're going to take a look at, if we can, we're going to try to find out what other companies in the industry are selling for. That'll give us our multiple. So that gives us a pretty good valuation of what the company's worth to get things started. Our goal in that case is to be within 10 to 15% of what an actual buyer would pay. The certified valuation is critical if you're doing anything that is going to involve the scrutiny of the IRS, because that's what they require. So if you're gifting the company to family members or someone else, you have to have a certified valuation. If you're considering converting from a C to an S Corp, you have to have a certified valuation as of that date. If you're transferring to insiders, you may want to have a certified valuation just so the IRS can't come in and say somehow you've transferred it at below value and there's hidden compensation there. So it's probably a good idea. You could get away without it, but it's probably a good idea to have it in that situation as well.
How are they certified, and who actually certifies them?
Certifying bodies for valuation specialists. There's the AICPA, American Institute of CPAs, of which I'm a member, and I'm accredited to do business valuation by them. There's NACVA, the National Association of Certified Valuation Analysts. They have the CVA designation, same thing.
Is that what designation do you have?
I have the ABV,
okay,
which is accredited to do business valuation. NACVA does the CVA, Certified Valuation Analyst. Mm-hmm. Then there's ASA, which is the American Society of Appraisers. They are they're definitely the longest standing valuation society and probably the most well respected and well known. But historically, they're real estate appraisers. In the past 20 years or so, and I may not have this exactly right, they've branched out into business valuation, but that's still a very well respected credential, ASA. But keep in mind, if you're thinking, there could be investment bankers or people who specialize in selling businesses in your industry. So they're going to know real world what your company is going to sell for. That can be every bit as good as getting numbers from one of the credentialed people. And in a sense, they are credentialed. They're probably CFAs or something like that. So especially in the early going where you're not worried about satisfying the IRS, getting the most real life valuation is what's critical.
Okay, you touched on this, but I'm going to ask it again. How is market and industry information factored into evaluation? And would you have an example of where it would be important for one business owner to have it factored in and into their valuation versus another?
Well, market and industry data comes in. I mentioned really valuation comes down to the expected cash flow and how risky that cash flow is. So when you're determining the riskiness of the cash flow, one of the methods you use with that, it's called a build-up method. And the idea is that you're trying to determine what rate of return the buyer of your company would demand. So right off the bat, if you're a company with less than $5 million of revenue, just by size, you're risky. So it may be that there's industry data out there saying companies in this industry sell for a multiple, they sell for a 4-time multiple or whatever. There'll generally be a range of multiples. And then you can look, again, you can get industry statistics and you can measure your company against those. If you match up, if you're at the top end, then you're also at the top multiple. If you've got a lot of weaknesses compared to the industry, you're going to be at the lower end. The nice thing about doing that analysis, and that would be part of the initial valuation, is it identifies how you can increase the value of your company, the transferable value. Because if you think about it, if your company's worth, let's just say your company is worth, or that industry trades from 3 to 5 times EBITDA, and your EBITDA is $1 million, but you're kind of a one-man shop, not a lot of infrastructure, customer concentration, maybe some other issues, so you're only a 3 multiple. So you do your analysis against other companies in your industry, and all of a sudden you've identified how to take your company from a 3 multiple to a 5 multiple. And probably by doing those things, you're also going to increase your EBITDA. So that's another good reason why it's important to start the process early, because chances are, if you can invest 2 to 5 years, you're going to be able to increase the value of your company and help secure your retirement. Market data is similar. You need to know what's going on in the marketplace. There are good and bad times to sell your business, just like the stock market goes up and down. It's very difficult to time that, but it is important to understand which market you're entering. You got to be realistic.
Yeah, and so it's natural for a business owner to want to sell their business for as much money as they can get for it. Right. And so when you talk to a business owner and you start that conversation, and you might ask, "What are you hoping to get for this business?" They will always give you a high number.
Yes.
Is there a place for evaluating with a discount or discounts? And can that be wise to do that, a wise strategy?
It can be in certain cases, and that's a really good point. Taking us back to why is it important to have a valuation? When you get your initial valuation and you see the value, that's going to help determine the options you have in the methodology to transfer your business. So, for instance, let's say that you need $5 million to retire comfortably. Your business is valued, and it's valued at $7 million. Well, that means that you could afford maybe to transfer some of it to your kids without receiving full fair market value, or maybe transfer to a key owner, something like that. So you have a few more options. If, on the other hand, you need $5 million and your business is worth $5 million at best, then you're going to have to probably go find a third party to buy it, because that's generally going to be the highest amount of cash you're going to get. So back to your specific question, in situations where you're transferring the business to family members, it can be very helpful to be able to get a discounted value, because you're going to not incur gift tax. Well, you could, but you're basically going to use up some of your lifetime ability to transfer assets to the next generation when you transfer your business. So you want the business to be valued as low as possible so that you're using up the least amount of your estate exemption. So the idea there is something called lowest defensible value. So you do a fair market certified valuation, you apply all the appropriate discounts, and you come up with probably a value that would be lower than you could actually sell it for on the street, but that's allowable in a fair market valuation.
So recently it's been publicized that the IRS is proposing new regulation regarding discounts.
That's right.
And I was wondering if you could explain the IRS proposal.
Certainly. So you can certainly understand the IRS position, because let me just give you an example. Let's say that we have a limited partnership that's owned by mom and dad, and there's a building in there that's been appraised, it's worth $1 million. They want to give 5% of that limited partnership to their son. So logically, the IRS looks at it and says, well, the building is worth $1 million. The son is going to get a 5% interest in this partnership. So the value has to be $50,000. But valuation standards say, no, that's not the value. Because what valuation standards say is, let me kind of build up that example a little bit. If I was going to buy a building from you and it was appraised at $1 million, I'd pay you $1 million for it. That's its value. But if instead you own that building in a partnership with someone else, so you own 50%, would I pay you $500,000 for that building? Well, I wouldn't, because if I bought it from you directly, I have full control. I can decide to sell it tomorrow and get my money. I can turn it into a rental and distribute cash to me. If instead I end up as a partner with someone else, I've lost control now. I can't demand that it be sold. I can't demand distributions. I can't even demand it be rented. So in the real world, it is true that a partial interest in a partnership is worth less than the percentage of the assets. But the IRS cannot stand the fact that value literally disappears. It just disappears forever. And that drives them crazy. So they have been trying in court for 20 years. They've tried everything. And the courts look at it and say, no, you can't do that. So what the IRS latest attack was what they call family attribution. The idea being that, in the example I gave, where it's a mom, a dad, and a son, well, anything the son wants, the parents would do, the IRS says. So it isn't really like he owns 5%. It's like he owns 100, or at least he has the control of 100% owner. Well, everyone knows in the real world, a lot of families aren't all that functional. And just because the son wants dad to do something doesn't mean he's going to do it. Mm-hmm. So it's really kind of ridiculous. And because of that, the IRS has lost consistently in court when they try the family attribution route. They lose pretty much every time. So finally, they convince Congress to just go ahead and basically say, in a transfer of a limited partnership or a transfer of a business interest amongst family members, you cannot take discounts. And the two big discounts are lack of control and lack of marketability. And you could oftentimes have discounts of 30 or 40% of the value. So it's a really big deal. And what Congress is floating out there, or IRS is floating out there, proposed regs basically say transfer amongst family members, no discounts. Now, obviously, they have hearings in December. Everybody in the business community is very upset about it. It really does not make sense from a real world standpoint. So we'll see what happens. Worst case. And then, of course, they probably won't be able to issue final regulations before the election. So depending on what happens there, the whole atmosphere could change for this type of ruling.
Okay, that's helpful. So Walter, in closing, what would you say to a business owner who might say, you know what, I don't see the need for a business valuation. I'm not thinking about exiting my business. Why do I need to even consider getting a valuation? Would you have anything to say to that business owner?
Yeah, because I think, the old saying, knowledge is power. Mm-hmm. At some day, you're going to exit your business. You're either going to, sell it to a third party, transfer it to family or key members, an ESOP, or you're going to die owning it. Whatever it is, you're going to exit it at some point. So it's critical to know how much it's worth. Because part of the valuation process is going to identify weaknesses and strengths. So even if you don't plan on ever leaving, your wife or your kids are going to inherit your business. You would prefer them to inherit a strong business versus a weak one. And the valuation process is going to help you increase the transferable value of that business. And like the point we mentioned before, you need to know how much assets you have. I mean, you can't do any financial planning without knowing what you have. And just guessing at the value of what is probably your largest asset is a very bad idea.
Great. Terrific. Okay, so if someone listening would like to contact you for evaluation, how would they do that?
I think the best thing to do would be to contact you, since you and I work together. Because again, evaluation in and of it, I strongly believe evaluation has to be tied into the owner's personal plan as far as what they need for retirement. So the idea would be they would come to you for help with planning out what they need for retirement. I could do the business valuation to get that piece tied down. And then from there, they've got all the power in the world. They now know what they have, what they need. They have an idea of what steps they can take to fill any gap that there may be. And you'll be able to put in a plan to help them do that.
Okay, if they wanted to subscribe to your newsletter?
They would email me at wdeyhle@grfcpa.com.
Thank you, Walter, for your time today. I really appreciate it. And thank you, folks, for listening. Stay tuned for future podcasts. In the meantime, check out our website, ennislp.com. Thank you.